We sold our house. We had equity into it, which was good. Smart move. I learned from my director, president, vice president, we got to diversify. The rates went up 400 to 500 basis points in the last 2 years.
Greetings, well builders. Welcome to Get Diversified, your go-to podcast for all things real estate investments.
I'm Jacqueline.
Melvin Landry. We're thrilled to embark on this wealth building journey with you.
Imagine this. What if your investments not only secure your future, but also unlock a life of financial freedom? That's what we're diving into on this show. Apartment buildings, storage facilities, mobile home parks, the whole shebang.
But here's the kicker. It's not just about investing. It's about crafting a legacy, building memories with your loved ones, and seizing every moment. Time is the currency of life. And let's be real, none of us wants to waste.
We've got the insights, experience, and dash of excitement to spice up your investing game. Plus, we'll throw in some real-life stories that'll make you see the potential in every brick and mortar.
Subscribe, buckle up, and get ready to turn your investments into the ticket to financial freedom. Together, we're not just building wealth, we're building the community of savvy investors. Let's get diversified. Hey, what's going on, folks? How we doing? And welcome to another episode of Get Diversified. I'm your host, Melvin Landry, and today, got a fantastic guest. Got a guy who's a mover and shaker in the real estate space. And guess what? Also one of my partners. Partnered on a couple of deals now. So I want to introduce the man, the myth, the legend, Ryan Dumas. How you doing today, sir?
Doing good. Thanks for having me. I appreciate it. Mel, how you doing?
Doing well, man. Blessed. Can't complain. So, Ryan, when we kickstart off the show, tell folks a little bit about you, how you got into real estate, and how the trajectory has gotten you to kind of where you're at now in your ecosystem. So let us hear the intro.
Real quick, I live in Clearwater, Florida, wife and 4 daughters. Very blessed, thankful, and grateful. And was in the restaurant industry for 20-some years. Stepped into commercial real estate finance, working capital equipment finance. Went into full debt finance a couple of years later. Still doing that. And I saw what people were doing. I saw people making the money, their personal finance statements and bank statements increasing. And I'm like, it's kind of like a job. I'm like, how do I just, stop making this, 75, 100, 200,000 a year and increase, net worth and have cash flow and everything. So that's kind of how it started. And the rest was history. I can kind of get into that here in a little bit, but, lost money, learned lessons and everything else. So big journey.
Okay. Hey, but so you talk about the journey, man. The journey, right? You've seen other people doing it. Why don't you share for the listeners at what point when you realize, hey, I need to be making a change. Something got to be different. So I got to take action. What was that stepping point for you?
Well, I guess the main thing is, you got recessions, depressions, and the COVID markets, and I mean. To get into that thing, I didn't know where I was going to talk about, but 2019 was a killer year. Made mid triple figures and made some really good money in the commercial real estate. I was going to some events with multifamily and already going to hotel events, and just lots of money out there, lots of people out there with what they were doing. I had 7 months. I made no money. And, hotels froze up, apartments where they were asking for a year, 2-year reserves. A lot of stuff was going on. So, I didn't have any cash flowing assets. I didn't have anything that was doing that. I wasn't wholesaling. So, people talk about the slow money, medium, and the fast money. I didn't have those things. I might have had a little bit of slow money working. But, that's where it was. And, and even in our field, when we were doing hotels for a long time, we were like, hey, and I learned from my director, president, vice president, we got to diversify. Let's start doing apartments and self-storage and stuff like that. So I was doing those, but again, that was the big thing. And to get into that, we sold our house. We had equity into it, which was good. It's a smart move. People talk about, should I rent? Should I buy? We had over $100K equity.
Yeah.
Bought a mobile home park. Sold that. Bought a motor home.
Okay.
A year old. Funny part, we had a bunch of breakdowns in that year-old mobile home, motor home, and we sold our house. They're starting to ask for financing. Going, hey, how you doing with not working? And so just in time, sold the house, got the RV at the same time, took off, went cross country, and wow. The rest was history. And I met people in different cities and states of Colorado, Hot Springs, Arkansas, and just kept meeting people. I wasn't making much money. I wasn't making any money at the time for 7 months. Was starting and trying to get in investing, and to kind of go over to the investing side. And if you want to get me more on that story, but on the investing side in 2019, which is before the COVID, went to Keystone, went up there. We were investing in deals, all new partners.
Okay.
All didn't know what we were doing. No coaches, no mentors really yet. Kind of, sort of, but not really. And that's why I touch on team and having experienced partners at least on a deal. And you're buying some duplexes and quads and everything. You might not need to. But so, yeah, we lost earnest money. And the main thing I guess you can say is, I mean, it was all our fault. You can say, hey, COVID came and then they wanted an extra 10% reserves. It didn't make sense. Numbers didn't make sense. I had earnest money. I had Patel law attorneys, owed them some money, and I'm like, listen, I'm not making any money right now. Can I pay you $1,000 a month, 7 months? He goes, yeah, I got a lot of people that just aren't paying me. So I paid the lawyer off. Already had, I don't know what it was, 7, 8, 9 grand in earnest money. Lost that, like I said. So wife didn't want to invest in real estate ever again. And me, you learn from those mistakes. And looking back, I heard that actually that one of the assets didn't even go through now in this last couple of years that somebody else took over. It was a hotel conversion. So I think also just looking back is having a solid team, having somebody that's boots in the ground that's local, having a good mentorship, coaches or whatever. There's some people don't need a coach, don't need a mentor. They learned it, they worked hard, but having mentors, having coaches, being in 1 or 2 mentorship program masterminds, I think is very good.
Peace.
And learn from there. Still had a couple of things with these. The rates went up 400 to 500 basis points in the last 2 years. The insurance doubled and some parts tripled. Just really looking to really be conservative, have extra reserves, have extra people that are helping raise capital in the team. And those are the adversities and things that we, overcame. And very picky about who we partner with and very picky, what deals we go on to. It's more about the team than the location and then the numbers.
Yeah.
And, we're good with team. We love working with Melvin and his wife. They're awesome. And finding out what somebody is good at on the team and having them stick to it. Hey, writing out some investor newsletters, helping out with the portal. Multifamily or self-storage can be easy, but you have to have that solid team and people doing little bits of that pie to be moving forward.
Okay, good. Hey, that's a really good kind of layout. You've spoken from end to end, right? I mean, it's not a one-man show for some of these deals. All these part of these deals we've been part of, a lot of folks on the team helping blocking and tackling to get it closed, implement the plan, and do what we say we're going to do, right? That's what we tell our investors. So, man, fantastic. Great segment. Let's talk about diversification, man. So, you like me, you're involved in many different facets. You're in lending. You invest in self-storage. You invest in mobile home parks, as well as multifamily. What has diversification taught you in terms of investing in all these different type classes? You want to share your insights on that? Because you're in a lot of different stuff, just like I am. So, any intel on that?
We have, not looking at my numbers, I think 5 self-storage builds. I think 3 of them are finished now or just about finished.
Yeah.
Things come up. So I would never want to have all development. I would never want to have all of one asset class in one city. So diversification is big. Even when I was financing, you learn from banks going, hey, they got 5 gas stations in this little city. What happens if people start moving to these other cities and that one little city goes from 5,000 population to 2,000 and everything? And that's called, was that putting all your eggs in one basket or whatever?
Yeah.
So diversification on classes in the same area. We have, I think we're in 8 different states now. So it helps. I mean, diversification. And then every year, 2, 3 years, every quarter looking at, hey, what's in demand? What asset class is in demand? What locations are doing better? And it's not always the hottest locations. I think it's always the hottest locations with the least amount of demand. We have an LOI we're waiting on to get signed for Wisconsin, for 300 single family homes at like about 20% of the value of the land in those lots, already entitled, ready to go. Who's building over there in Wisconsin right now? Not many people. Now the curve is going up. They're increasing little bit by little bit. Workforce, a lot of workforce housing, a lot of blue collar. So it's not like it's, like Phoenix and Nevada going up and down 15, 20% every couple of years. It's very stable, and there's a very big demand of affordable housing and very low crime. So, we like to diversify. I mean, I'm never into office space. Right now, office space is, I think it's the highest of default ratio from when we looked on our CBRE last month.
Yep.
Again, we like warehouse and we like affordable housing right now. Now, 3-4 years ago, we weren't looking at affordable housing, but right now on the finance side, people are calling me going, hey, I want to build 100 mobile homes. I want to put 200 modulars. I want to do 400 square foot tiny homes. So, and you can tell what's going on in Cincinnati. I think it's 30,000 people they're in need of housing. So again, that just tells you throw in a couple of hundred houses that are affordable housing, you're not even taking in a few percent of what's needed in that area now.
Yeah.
So that's just a couple about it. But I mean, I know people that invest into one asset and then one asset class slows down, and then their investors are like, oh, well, we probably should have invested. And I even tell my investors, I'm like, I would invest into a couple of different operators, a couple of different assets, a couple of different locations. If you really trust the operator and they're like putting in 3 locations, 2-3 assets, that's awesome. But also on diversification, I don't like it where it's sped up and you're like, hey, Ryan's working on storage, industrial, warehouse and flex. He's developing, he's doing apartments, he's doing this and that. I work with partners that are really good at each one of those assets, partner with them, help them raise capital, put in some earnest money, sign on loans, and we go all in together. And I try to bring in as many partners as we can to take the deal down. And right now, raising capital is hard. So we all raise together. We all have a role, and plus we're raising together. So we're not, hey, we need 5 capital raisers plus us. We're all of us have a role, all raise capital together. And I think diversification is awesome. I think it's great.
Good. Yeah, man. Absolutely. In terms of, you think about, right, fulfilling the bill, right? Partners coming together, raising capital, taking down deals, executing the business plan, realizing the fruits of the labor at the end of the day, and the progress too. That's what kind of fuels the motivation at the end of the day. So, fantastic.
Yeah, what do you do when you invest in something? I mean, like hotels are mainly for cash flow. Mainly, they don't really sell for a much higher cap rate. They kind of do, like if it's on a larger scale, but usually you build a $25 million hotel, and the next year later, 10 years later, it's worth, 10 million less or 5 million less. But then it's going to a Best Western, and then it goes to a Roadway, and 40 years later, it goes to a Budget Inn. So, I mean, apartments, they usually hold that value, and you don't have to be handed by a franchise and online travel agency at 10, 20, 30% of your revenues. So, but yeah, if you invest in all self-storage, and what happens if the zoning changes and then you're out in the middle of nowhere like it did recently? I went to downtown Bradenton, Florida, and they have right in the downtown city, they have 500 units right there. Now the guy that was down around the corner back down there, he's not visible. And usually the lady, not always, but usually the lady wants to pick out the self-storage. I want a safe place for my couches, my furniture, and my mirrors and everything else. So they're the ones. And if that zoning changes, you had 4 of them that were kind of tucked in somewhere else, you might not be on the scene now. And now you have 4 facilities that are doing well. That's just one instance, but I mean, it's why it's good to diversify and everything else. So
you think about, man, you're invested in many different classes. what has been your unicorn segment? Has it been multifamily? Has it been storage? Won't you tell the listeners which one or which are your top two that you like, that you've invested in, and kind of speak to kind of why you feel that's a niche for you?
I mean, so I'll start with self-storage. We're doing a few development, a few add-on and everything. And, one of them, Melvin and his wife are partner with. But reason I like that is you can build them self-storage facilities as we saw with our last weekly call. Them things are being put together quick. I mean, it looks like it's about 90% done. It's probably 65. I don't know the number and everything, but it's done. And we got 56,000 square feet. I mean, it's a big place. So
yeah,
so one thing is they get put together quickly. It doesn't cost as much. Zoning is a little bit easier. And then, once you get these things filled up, you need a part-time employee. So yep. I think that's one of the things, another thing to think about in this day and age is, I sound old, but labor. If you can't find 4 or 5, 6 people to work your leasing at your apartment or your business, it's actually better, I think, to find something that has less employees. Went to a Checkers a few days ago, and there's that AI at the beginning, and one person was running the whole place. So,
wow,
all these things you got to look at.
Yeah,
there's the Burger King, I think it is in Vegas, with not one employee. So you got to find out where the trends are, and that's all, with diversification. But I like to sell storage because of less employees. I think the second biggest one, I mean, there's self-storage, mobile home park, and I would say warehouse. Warehouse is where everything's at. People are, leaving some of the storefronts. There's ghost kitchens and everything. They're pretty quick and easy to build too, like self-storage.
Yep.
I don't see them really going away. The other one would be mobile home parks. I think affordable housing is very big. There's a very big gap between affordable housing and that mid-level income. And I think that those $200-$300 a month rents are going $400, $500, $600, which that's almost tripling. That's doubling, if not almost tripling almost.
Yeah.
In some of these areas, I've seen people go from $250 to like $600 in the lot rent.
More than double.
So I mean, yeah, I mean, who cannot afford in some of these places are, there's tenant-owned and park-owned homes, so you can still have your own place in there that you own.
Yep.
And then as a mobile home community owner, I call it community, sounds better than mobile home parks. And buying these things, you can come in there and do tenant-owned, and your expenses are pretty low. You're not taking care of everything. Now, tenant-owned home park-owned home can be really good. You can get that $800, $1,000, $1,200 a month rent.
Yep.
But your expenses, 40, 50, 60, 65%, I've seen them pretty high. Again, now, if you want to cash flow in your local, or you can have somebody that run them, you can cash flow those pretty good. I've seen some people with, 300, 500, 800 of those units, and they're cash flowing really good. And what they're going to do in a few years is turn those over to tenant-owned home, sell them to a REIT package, but they'll cash flow them now. But there's different ideas that people do things different. I like to get something in there, have good partners that are on the ground in those assets. And like I said, the reason why we like the self-storage is once it's done and complete, we don't have to be checking on that thing like a property management at an apartment every week, twice a month. I mean, we can look at cameras. We can see that, 5 people came in that day with their key fobs and checked into their unit and nothing got banged up. Like, all you're looking at is pretty much somebody that banged something up with a cart or a car. And that's really about it. And it's minimal. So, I mean, those are the reasons I like those. And they're all pretty much easy to finance.
Okay. All right.
So again, there's all kinds of asset classes out there, Melvin, like restaurants and everything else. Restaurants, bars, and clubs. When I was younger, I was like, I'm going to own a bar or a club or a restaurant. I have people like, I worked 80 hours a week in this restaurant. I want out. And again,
done that.
You might like it. I told you guys, and then talked to you guys, I worked in restaurants for a long time. Now, there's people also that want to work in gas stations. They can be good too. And I think there's been more with gas stations with more computers and some of those things changing, because I went to a Shell. It used to be like 2 or 3 cashiers, the big one.
Yeah.
Where I'm at, and it's just 2 or 3 speed access ones. You can put your card up to it and pay yourself now. Express lane, and I think 1 employee now. So it looks like they're going down on the expenses. But I know people, my buddy Max, I got a couple other buddies that own or owned gas stations, and they'll work 70, 80 hours a week.
Thanks.
Because somebody steals something that's just $10, $15 from your store, it's all like you make 2 cents here, 5 cents here, 10 cents there. So a lot of work. I don't want to be working 80 hours a week at one location. Want to get something set, make some money, get a good team, and go to the next thing. So
cool. No, I look, you're not preaching to the choir on the restaurant piece. I've been there. So don't want no part of that ever again. So
I know.
Yeah. Hey, you earned your stripes. That's for sure. So man, so you talk about storage, you talk about mobile home parks. I mean, what are like 1 or 2 asset classes like you're like really concerned? Now you're in finance, so you see it all. What's scaring you right now, man? What's on your radar to run away from in terms of asset class right now? I know you're probably going to say office space, but what else giving you heartburn potentially from an asset class standpoint in this environment?
I mean, so besides office space, I mean, I can just, I could give it on a smaller scale. Yesterday, I went to go to the store I take my kids out every Thursday, daddy-daughter date, every Thursday. That's what we do. And looked across the street, the Subway is gone. Been there for, I don't know, 10, 20, 30 years.
Gone.
And I didn't even mean to get on Subway. I financed a few of them, and I got a few friends that own like 10, 20, 30 of them. And then about a week before that, I saw another Subway gone. Last like 3 weeks ago, I saw $2 stores out of the way. So It's weird because a lot of these food and dollar store franchises, some other franchises are gone. Now, it's not saying that all Subways are not good or all dollar stores. I think is they built too many dollar stores within a certain per square mile.
Yep.
Because I would see a Family Dollar and then a DG and then a Dollar Tree, and it just got to be, I think, out of hand. So, I mean, I think the things that scare me are these franchises that maybe don't have a real feasibility study of what they're going to need for, I guess, supply and demand, people that are there. And some of the franchises, not to get bad, they don't really care. Hey, you're going to give me 25, 30 grand in royalties. What do they have? They're not paying for the land. They're not, I mean, in 7-Eleven and McDonald's, they own the land. So again, they could kind of care less about some of that stuff, but the franchises, they'll get their $45,000 fee. You'll get your application. You'll pay your $100. You'll pay this. You'll pay that. They're not losing anything. They might have a bad rep for losing a few stores here and there, but even Hilton and Marriott and IHG hotels, they used to do really good feasibility studies, and other hotels would just climb in there. Now, there's like a Holiday Inn here, another Holiday Inn like 3 miles away, and they used to be like a 5 mile away.
Okay.
So again, I think things have changed. People got kind of maybe too greedy of certain franchises. I would be careful on a lot of franchises because they're the ones that are making the money first. Hotels can be good, and if you're a good operator, that's awesome. If you're not a good operator and you're trying to jump into it because you see the cash flow, be careful. A lot of the hoteliers I know from India, the West Coast and everything, they live in these hotels. They breathe in these hotels.
Really?
And if you're buying from somebody that has family that work in the front office, the back of the front office, and you think you're going to reduce expenses, I've seen $200,000 salaries go to $350,000, $400,000 from some people buying from hotel operators that were running it there. Like, oh, he can do this, she can do that. I'm like, yes, it might need a renovation. It might need a little bit better management. But if you got 6 employees working there that are family and there's not much on the payroll, be careful. It'll go up. So I think hotels, if people aren't traveling and going on vacation, like this year, hotels have slowed down in 24 and part of 23. So I would be careful on that. And they're a day-to-day business. If I get a hotel reservation, I can cancel within a day or two. I can cancel it at an apartment, which is, kind of back to where I'm not doing a whole lot of, but we're still investing in them. I signed a 12-month lease. I'm in. I can't just because my exit closed down.
Yeah.
Because it's hard to get into. I'm there. And like I did a hotel in Temple, Texas, and 2 years the two main exits were closed down, and they lost like 30-40% revenue for 2 years. So again, but if somebody had an apartment there, they're still going to try to find a way to their place. Eventually after a couple of years, they might say, hey, I got to find somewhere to live.
Yeah.
Self-storage, you're going to go there once a year to pick up your Christmas stuff, or you move every couple of years or whatever it is, you're going to pick up your junk. So they don't get as bad. People in mobile homes, some don't have cars, some don't travel as much. And a lot of the mobile home park people, they live there for 3, 5, 7 years.
Yeah.
So, I mean, those are kind of the assets that I like and don't like. And trust me, there's people I know that own 5, 6, 7 restaurants that crush it. There's people I know that have 1 or 2 hotels that crush it. People that have 10 hotels and crush it. Now, again, but there's people that I know that are good operators of the hotels. They're going down 15, 20% because of the area is, and there's nothing they can do about it.
Really?
So,
wow.
And mobile home parks right now and warehouses, I do not see them going down. They're going up. Look at me, like our mobile home park, I think is about a 127 under rent, and the neighbor just increased $50 during when other stuff is going down right now and going out of business. So that's why I diversify, and that's why I work with partners that are really good at what they do.
Yep.
So I don't have to learn a whole new asset in a month or 2 months or a couple of days. So,
nah, man, that's
and then that's why we did the core. The core wasn't because, our mentorship program, because we have the most assets. We've been doing it the longest. That's not what it's about. We've had mistakes. We've learned from mistakes. We learned from partners' mistakes. And we wanted to be in a group of people that, can learn from our mistakes, can all work together as a team to learn that team is the most important. And just been in coaching programs and seeing other stuff that other people are like, hey, I got this program and it's $50,000 and I don't see anybody or anything. Or, hey, I paid in this program and during COVID, they closed it down or whatever it is. So
yes.
We just wanted something that people can be there, talk about family, talk about things. We've had people going through, different ailments and conditions and losses and divorces, and hey, what can we do? It's like, well, for the 200 some bucks, and then after a year, it's $99. People are like, you really care? I'm like, we care. Like, I think you're coming down to Jolene's house, whatever it is, and meeting Wednesday. I'm trying to meet over there. So
yes, yeah.
I tried meeting with what's his name, Tony Brown, but it just didn't happen. He leaves early tomorrow, but trying to meet, because that's what it's about. The more people meet in the group, and sometimes on Facebook or whatever, you meet 2,000 people or whatever it is. You don't know who's who, but if you have this good little circle and you try to build it and get that pie of who's the best underwriter that can get on my team, who's a good person that's doing due diligence, who's really taking control, because it's hard for one person to do all those things. And if you've never gotten a multifamily, you think, oh, I can't do this. I got to learn asset management and due diligence and underwrite and raise capital and this and that. All you got to do is be good at 1 or 2 things and find a good team. It's simple, but it's not easy.
Yeah, that's true. That is true. It is simple, but it is not easy. Yeah, yep, indeed. Man, power of partnerships, man. You've spoken into existence. Look, the power of kind of finding the right team, finding the right individuals. Look, it takes time. It takes a considerable amount of time, right?
That's really, like right there, what you said right there, it takes time, because some people will get into a mentorship mastermind or whatever and go, hey, I 3 months and I'm giving up. I'm like, no, man, it takes 3 months to close the deal. So, I mean, you got to find a deal. You got to underwrite. And right now, with the market, with all those things we talked about, the rates, insurance, this tax, everything going up, the deals aren't making sense. Now watch when some of these things fall, because those things went up so high. Now you're going to be buying at a low. You got to buy right. It's about how you buy. And if you guys are buying these duplexes and quads and singles at a good price, cash flow in those things, keep those things for 10 years. What do you think? Those values are going to be 70%, 80%, 100% more than they are now. So, and I got people that just want to get a first deal. I'm like, don't just get a first deal. Don't just build something just because I got a brand new restaurant or brand new hotel. Build something that's going to do well with a solid team in a solid location, and you'll do well.
Yep, absolutely. Ryan, it's been great, man. You kind of laid out the foundation of, hey, even if you're new or even if you're well seasoned, what you should be doing, what you should continually be doing, what some things you should be looking at, as well as the different classes, right? Asset classes, they're different. Not all are the same. So, man, thanks for sharing that intel and that insight, man. So, man, how can folks find you, man? Where do you want to share information on your website as we kind of wrap this up? Email, website information. How can folks find Ryan?
Well, for one thing, I'll tell you, the website is investinmultifamilyus.com. And again, it's not all about multifamily. That's just where we start off at. Single family does well at certain times, and certain things do well. I am maxed out on Facebook. You can follow me on there, just Ryan Dumas. And best email for finance is rdumas, DUMAS, at GRP, capital spelled out, CAPITAL.com. And my email for investing is Ryan, RYAN, at Kingdom, KINGDOM, CRE.US. So that's a couple of my emails, phone number. And if you guys have any information or any questions or anything, Melvin can share it. But yeah, we've closed on a lot of deals, and it's just not like, hey, Ryan's has 3,000 units. We've had that experience of closing those deals too. So if there's anything that we can help out, call, text. I'm not big on DMs. I can't catch up on them. Very busy. We do have a bookkeeping company where help people out with their bookkeeping, because I think bookkeeping and CPA and get your numbers fixed and straightened is very important. And if you guys we do cabin retreats with core members, without core members, it's good, because then you get that intimate where you're like, oh, I can hang, oh, Melvin, no, cool, Ryan, I'd partner with them. Or Ryan talks too much and I don't think they're really good operators. Let me move on. But, we usually have about 12 to 15 people at our cabins. They're about a third or a quarter of what others charge. And we just pretty much pay for the cost of the cabin, the food, the drinks, everything in it. And pretty much if there's any money for activities, we'll do activities. So it's pretty much, it's not for us to make money. We're not making 50, 100 grand at these events. We're not these gurus or anything at all. I love people that we can learn from. And people that charge a lot of money, you can learn from them. I always try to pay more and more for education every year. So, not to talk bad about that, but we just like to have a group where we can just get it paid for and everybody talk and speak and everything. And the more you're hanging out with people that do what you want to do, you can become what you become. And if you're not hanging out with the people that are doing deals successfully, ethically, morally, you won't do them. If you're hanging out the bars and the clubs and all that, you're not going to be closing deals. And I mean, not just talking about, going there once in a while. I mean, you talk of who speaks around you and how you listen to them. I've changed a lot with my language and what I've learned and matured on, but yeah, give me a call at any time. If you guys are interested in joining the core, going to the cabin, learning about anything about it, let us know. And we do have a couple of meetups a year, but yeah, Melvin's our partner. And if you guys have any deals or anything going on too, the mobile home park one right now, reach out to Melvin. Yeah. Great guy, great operator. He's got his own portal and information, and reach out to him. I can help out with any questions. Reach out to me too.
Good. All right. Hey, man, look, this has been a fire interview, man. Good sharing the intel. Good sharing your thoughts about different asset classes, financing, the power of partnerships and association, which is so true. So true. 5 people you hang around with, 5 people who you are collaborating with on a daily basis, 9 times out of 10, you're going to be the 6th individual. So, association and who you hang with, and even beyond that, some of the actions, right? We all talk about taking actions, right? Being able to just execute on some of the small things. sometimes the small actions bring the larger rewards. And mindset is your greatest asset. So
they do, man.
Your attribute to that, you've been knee down, moving forward, pushing the needle, and you're closing deals. You're closing deals, and you're getting stuff done, which is good.
And also, too, I mean, people that are out there trying to get 500 units, 1,000 units, or they're sick, don't get frustrated. It's hard. It's not like, hey, I've had an easy road or anything either. I can tell you, it's rough.
It is,
and everything else. But the more you surround, the more you push through, the more you get through. It gets better. And I mean, you got to push through these storms. I can't tell you anybody out there it's like, hey, I've raised 50 million, 100 million. It's easy. Now, some people have, but they've been around these people that have a ton of money. They got on a really good team.
Yep.
And they've done it the right way. So it happens, but don't push through. I mean, give yourself time. But again, all the things I said, get into a group, get into a free group. Facebook's free. Don't go out and spend $50,000 in a mentorship program. And then also it's your fault if you don't put your work in and go in the group, get on the Zooms, get on the calls. In the core, we have a few people that don't ever get on, and we buzz them. Do people in the $50,000, $100,000 programs? I mean, they do sometimes. Some of them do, but we'll call it. Hey, Mike, I haven't seen you in a month or two. I got a guy meeting up in St. Pete in 2 weeks. He's in our group. I haven't seen him on Zoom in 3 months. But again, so we try to. We love what we do. So
yep.
If you love what you do, you don't work a day in your life.
But it's true. That is true. You love what you do. That's a quote of the day. If you love what you do, you don't work a day in your life.
It's like Carnegie or somebody has that or something out there or whatever. But I love it. I mean, sometimes you do get burnt out or you do work Friday. We have a Zoom today at 7:30 on a business deal. It's a 2.5 to 4.5x equity multiple on a medical insurance business investment. It's going to fill up quick. But again, 7:30. I don't usually do stuff late, but we have that.
Sometimes you got to sacrifice. Sometimes you got to sacrifice. Well, right, hey, man, look. Man, this has been a fantastic interview. Good that you're sharing the intel and nuggets. Hopefully the listeners can garner something from your intel in terms of the power of partnerships, the power of taking action, the power of, even I know a lot of folks are out there chasing the big kahuna, 500 deals. Dang it, in this market, there's a 5 unit that's cash flowing, go get it. Cash flow, get depreciation, and kind of build a portfolio that way. Look, everyone wants a home run, but guess what? Bunts and base hits, they get you on base too.
I want to interrupt one last time. And for any wholesaler that's been charged a 3.5% fee for a year and a half, 2 years, put that fee down to 1%. Partner with somebody, and people that put no seller finance, but they haven't even tried. They just don't want it. Work, communicate. I mean, it's just trying to get that one win that's going to retire in 1 win or 3 years. Go in less. I mean, I did deals for nothing. I did deals at 1% equity, 2%, 3%. So again, man, it's important to learn. It's important to work for free sometimes.
It's true. That is true. Sometimes, what it calls for, but thinking about futuristic, right? We're with the eye on the prize at the end of the day. So sometimes working for free may bring you opportunity if you can learn, if you can build on something, right? So, evaluate every opportunity accordingly. Think about and know every situation and understand, there's pros and cons to everything. There's risks to everything, right? So you talk about the restaurant, I've got my war stories and as well on that. So, hey man, fantastic. So Ryan, this has been a fire interview. We appreciate you jumping on, man. And hey man, great to partner with you. And on behalf of myself and my wife, Jacqueline, man, it's a pleasure for you being on the show. We appreciate you, bro.
Thanks for having me on, man. God bless, man. Thank you.
Yep, you got it.
Jacqueline and Melvin, thank you so much for taking time out of your busy day to listen to this episode of Get Diversified. Please make sure to subscribe to our podcast so you don't miss out on future episodes. Finally, stop by our website and follow us on social media. Ciao for now. Make it a great day, and we'll see you next time. And remember, get diversified.